So welcome everyone, Exploring the Process, episode 2. We've got a special guest today, Joe Cat, as we all know him on Twitter, or Fracty Cat, at Fracty Cat. So if you don't follow him, I definitely would highly recommend it. We're really excited, Chris and I, to walk through his process with him today and to share it with you guys here afterwards. We've kind of going to run through a couple different things, sort of similar to the first episode. We're going to walk through how Joe found Hedgeye, sort of a bit of his investing background, and then go through, as I teased out on Twitter the other day, he's kind of worked on this bridge band math and how he incorporates that on some of his trading view scripts and stuff like that, and sort of how he incorporates that into his overall signal and the strength and takes that and then kind of builds a portfolio and invests outside of, with those with that math or signals and that kind of thing. And then we'll talk about some mistakes that he's made over the years and then obviously his current market outlook as well. So, with that, I'm actually kind of just going to pass off to Joe, if you don't mind, just sort of, running through how you found Hedgeye and then kind of we can go into some of the other subjects.
Awesome. Yeah. Thanks for having me, guys. So my name's Joe Cat, or Joe Catanzaro. And I've been with Hedgeye a few years. I've been trading since kind of the end of 2014. And, the way I started was like about as old wall as you come, like technical analysis, chart patterns, candlesticks, moving average based indicators. I started, I think, the way a lot of people do. None of it worked. Not for me. I didn't make any money doing it. I didn't really fly into it blind. Like I read all the trading books, like you name a classical trading book, I've read it. I did everything the book said. So I wasn't taking big losses, but I was dying by 1,000 paper cuts. I'd open a position, set a stop, get stopped out. Open a position, set a stop, get stopped out. And my path of learning how markets work kind of took me to code. So I started using, they don't even exist anymore, I don't think. Quantopian was like kind of learning Python and building trading algorithms using Python. So I started there. I back tested every indicator that I was reading about. So all these books were telling me, moving average crossovers or chart patterns or indicators, MACD. I back tested all of it. None of it worked. There was no edge there. And that was kind of shocking to me, because I'm reading these books and it's like, oh, do this, this, and this, and you'll make money. And it wasn't working. So for the next couple of years, I had little success trading, and I took some time off in between, paying back student loans. And I'm like kind of just trying to get, ramping up my learning. So I'm still reading books. I'm still learning to code. And then I started learning about global macro through, I found Real Vision around that to 15, 16, 17, somewhere in there. I know a lot of people, use Real Vision, great service, a lot of smart people. But learning macro, it made me smarter, but it also didn't make me any money.
No edge, right? No edge.
I didn't know how to apply what I was learning about. I learned a ton about how the world worked, but I didn't know how to actually apply that to trading and investing and making money. So, I'm listening to Real Vision. I'm listening to the Macro Voices podcast. Chris, I think you mentioned that. I watched a video from last week. You were listening to that. I was listening to that every week. And I knew all the guests, repeat guests. I knew all the narratives. I heard all the guest views, and every week it's a different long-term view. Like this guy's bullish, this guy's bearish, and here's why. So this is about the fall of 2017, a guy comes on Macro Voices named Keith McCullough, and he's talking about the quads, and he's bullish, and I don't really think anything of it. He's just another guest, and he's bullish, and this is why he's bullish. All right. So fast forward a year later, and it's the fourth quarter of 2018, and Keith McCullough's on again, and he's bearish. And I remember his name, and I'm like, wait a minute, this is a first, right? Like this guy was bullish. And he was right. The market ripped into, through the end of 2017 and 2018. Now he's bearish. Is he going to be right again? It's kind of the first time I'm seeing someone flip and have a reason for flipping. Right. But I still don't look into it. Then a month or two go by. I remember it was like my son was born kind of at the beginning of 2019. And I'm overtired watching Real Vision because I'm trying to just stay awake and watch my son. And Keith McCullough sits down with Raoul Pal. That was the first time he did an hour interview in, I think it was first quarter, maybe it was January of 2019. And that's where it all made sense to me, because I was watching it and he showed a visual depiction of the quad model.
I love that.
Everything was, and I was hooked after that. I subscribed to Hedgeye the next day, and it's been kind of a very quick ramp up in terms of it was all of everything I had learned up until that point was all this disparate knowledge. And what the quad framework did was take everything that I had learned about put it in, like compartmentalize it in a way that made sense. So it was like, you know, like gold, for example, you know, like the kind of conventional wisdom is, oh, gold is an inflation hedge. So if inflation's going up, gold will do well. Well, that's actually only half true. And that was like, you know, a big thing I learned from Keith was like, gold doesn't, it cares only, the fact that it cares about inflation is half the story. It cares about falling real yields. It was just something like that. It was like a light bulb going off. And I was like, oh, that actually makes perfect sense. So it was everything that I had learned up until that point started to fit into a box that made sense and allowed me to learn a lot faster.
So, Joe, sorry to cut in.
Yeah.
What can you remember what quad it was when you hit the button to subscribe?
Yeah, it was it was right after his quad 4 call. So it was the end of 2018, that slowdown.
Just coming into 2019.
Yeah, and if you recall, there was they were still calling for quad 4 into 2019, but it actually got pretty hard around then because there were issues with, like, I remember it was like the government shutdown meant that they couldn't see the positioning, and the fact that everybody was on the short side of the boat. And if you remember, that was like the plunge protection team coming in, and it was like this this wave of liquidity and accommodation from the Fed was kind of mucking with that quad 4 aspect a little bit. So the shorting aspect was tough, but the duration side of it, so like utilities, bonds, real estate, those things did extraordinarily well. And that's where a lot of my positioning was. So the short side was hard, but the long side of quad 4 into the beginning of 2019 actually worked quite well.
Yeah, cool.
Yeah. So that's it. That's kind of a primer on how I found it. But yes, so yeah.
Yeah, so you and Chris basically came in around the same time then, because Chris, you were like the fall of 18, right? I believe, if, from last week, and then so it's interesting that you guys kind of found it through a similar channel, right? The Macro Voices.
Yeah, it sounds pretty much around about the same time.
Yeah. I've not seen that Real Vision interview, but I'll definitely need to try to get my hands on that one and kind of go back to the books on it. But that's awesome. And so then
he's gone a few times, but that was like the first one.
Yeah, absolutely. And so then once you started, you said it kind of made sense for you from like a quad perspective. And then, but it sounded like you'd already kind of gone down a bit of a path of sort of coding or trying to incorporate kind of, quote, quote, like automate it or kind of take the emotion out of it. So then did you just dive deeper into that process to kind of get that bridge brand mass into play?
Yeah. And we can go down that rabbit hole too. I mean, so I'll tell you that initially when I started doing things the Hedgeye way, doing things Keith's way, I lost even more money. So in the beginning, there was a steep learning curve. So the biggest change was the idea of incremental buying versus all in, all out. So what I had done up until then was, I have a view, I think I'm going to make this trade. And that was also a function of like, I'm just starting out. I got a relatively small account. And you think back to 2015, 16, like E-Trade, it was like $10 a pop to go at like $20 round trips, $10 in, $10 out. Well, when you only have a couple $1,000 in your account, that's a huge chunk of what you're trying to make per trade. So you are going to go all in, all out. Free commissions change that. So that was like kind of at the beginning of free commissions. It was like 2018, 19, somewhere in there.
I think it was like the fall, right? I think they all came out like late summer or something like that. It was like either 18 or 19. I forget when it was, but yeah, it was right around that time. Yeah. Yeah.
And I didn't appreciate at the time the huge opportunity that was for retail, because that allowed retail to trade the way hedge funds trade. Because if you trade millions of dollars, that the commission is a rounding error. Yeah. For us, for us small guys, it was a big deal. But once it was free commissions, now you can trade the way they're trading.
Yeah, you can touch your position so much more frequently. Yeah.
Yeah. So one of the biggest mistakes that I made in the beginning, because now I'm learning a different way of doing it, was incremental buying kind of in the wrong direction. What I mean by that is, I understand the concept of buying at the low end of the range, but you can really get upside down if you don't have a process around how you buy at the low end of the range, meaning you can get in whatever your starter position is, however you define it, and then you can get big and big, like big to a full position as this thing is going against you. And one of the biggest changes that I've made recently is, what I certainly don't want to do is be in a full position as something is breaking trend. If you're defining that as how you stop yourself out, I want to be small as I'm stopping myself out, where it's a position I'm not even looking at and just kind of, just get it off the book and just ignore it, not take a big loss. In the beginning, it was inverted, where it was like my biggest positions were the things that were working against me. And you can get upside down the other way too. Because if you're in and something starts to work,
and you're
sell
only
at the top end of the range. Now all of a sudden you look at your portfolio and the things that are, you know, accommodative to you, the things that are strongest in your portfolio are your smallest positions.
Correct.
Weakest things are your biggest positions.
Correct.
And that'll just eat you up. So that was like the next learning curve for me, was figuring out how to size within this new system that I was getting taught.
And now, do you follow Keith's general rules about kind of basically like 6% for an ETF, you know, 10 for fixed income, in terms of like basis points of exposure?
Yeah, to a degree. I think I use a different sizing system. So I actually operate on bips of risk rather than bips of capital. And there's a couple of reasons for doing that. One of the big reasons is it allows me to volatility adjust the position a bit. So, you know, something like, you know, a currency like UUP, I'll get very big in if I want to be in that, because it moves such a small amount. The volatility is so low. Whereas, you know, I understand the way that he does his sizing based on asset classes, but if I look at something like an equity, you know, Playboy is a lot more volatile than like, you know, Ford or McDonald's.
Or Dollar Tree. Yeah, exactly. Yeah.
It's much more high beta. So the way that I do it, I'll actually have a smaller max position size from an absolute dollar standpoint in something like Playboy than I would something like Ford, even though both are equities. So that's just a way that I just kind of changed and kind of on the cutting edge of what I'm trying to adjust like right now about my process is I actually want to tie, and we can get into, I'm sure as I get into some of the math, we'll get into like 1 and 3 month price momentum and the importance of those things, to tie the max position size to aspects that change like that. Meaning if something has positive 3 month and 1 month price momentum, whatever my max size is, really allow myself to get that big. But if something has maybe positive 3 month price momentum, but 1 month price momentum just went negative, lower my max positions. Okay, so instead of 200 bips of risk, my max position is only 100 bips of risk until that momentum recaptures itself. That's just a way to kind of impose a sizing limitation. It's like everything I'm trying to do is about getting the sizing correct, meaning getting bigger on things on the way up and smaller on things on the way down. And that's counterintuitive to the idea of buy at the low end of the range, sell at the top end of the range. So it's hard to keep those two things in mind. And the more I've heard from Keith over the last couple of years is like, that's sort of like the 101 education that he's giving people is buy low, sell high, buy at the low end of the range, sell at the top of the range. But if you really listen to the nuances of what he's saying and how he's trading, he is getting bigger in things that are going up, smaller in things that are going down. And you can't do that just blindly buying at the low end of the range. You have to have a sizing system overlaid on top of the risk range system or the system that you're using to define low and high.
Yeah. And that's something that's definitely come to me from most recently with calculating with Keith's risk ranges. I have this center line, so the middle line in between the top and the lower range. And you can see that the volatility is much higher when it's below that. So when it's in the lower half of the range, the volatility is much higher. And then you kind of have this, I know a lot of the conversations in the notebook reviews and stuff have been about gamma. And I don't know if it has that, but definitely when it's in the top of the range, not at the top, in the top half of the range, it kind of has this much lower vol, much lower daily moves, but it has that grind in just kind of positive, just it keeps going and going and going. And incorporating that with bridge bands, which I use to start building that position. It's like you say, it's like with anything, when something's tried to be made simple, so it's easy to transmit it, it takes some of the nuance out.
Yeah.
To
absolutely.
be able to.
And so a question I had, because I do want to get into bridge bands, but a question, kind of an overarching question on that is, would you say that you have a different set of rules or maybe just different behaviors depending on if price is above or below that midpoint? Like, are you treating it differently within the range? Like not everything within the range is created or treated equal?
Yeah, for me, I've only done the analysis on the SPY, on SPX, and I'm working to do more based on the risk ranges to see if the correlation is the same. But yeah, basically anything that's in the lower half, whether it's bridge bands or risk ranges, anything that's in the lower half that's kind of my trading range where things can move backwards and forwards. And then as it gets, without mucking everything up with positive gap, but once it gains that momentum by moving into the higher half, you can kind of let things run. And last week I discussed that where trades have these different things where, you know, buying at the low end of the range is you're basically making a bet on mean reversion, right? And then as the trade continues, you're having this positive gamma kind of move of, or just to simplify it, call it trend following. Once it's in, you're kind of trend following the move, and then you're managing it again once it gets to the top end of the risk range. And it's marrying those different types of trade all in one trade.
Yeah,
it's not just mean reversion. It's not just trend following. It's not just this.
It's both, and that's what's great about the risk for his system is that the Hedgeye system is that it's mean reversion, the advantages of mean reversion within the advantages of trend following. So I think we all agree that markets move in trends, and that's how you make big money is you capture that trend. Yeah. But he understands the advantage of mean reversion and playing mean reversion in the, you know, the context of markets 90% of the time, whatever it is, where they're episodic and non-trending, where those spikes in volatility, those decreases in price are giving you huge opportunities to goose your returns beyond what you get by just buying and holding. I think that's what he's trying to do. And the mistake that newer folks, even me, can make is when you don't have a formulated process or system built around that, you can chop yourself up and actually do worse than you would if you would just buy and hold. So that's the thing, is it's a steep learning curve to what he's doing, where you're actually better off buying and holding up to a point. Then there is a huge advantage to doing it the way that he does it. And you have to kind of get through that learning curve and get to that point where it becomes
a big chunk of that is diversification as well.
Yeah.
Like if you've just, it's why I always like to ask people how, like, what quad they were when they joined. Right. Because you'll have like if you joined in April or May of 2021, you'll have kind of had this story before you click the button to subscribe. You'll have had this story about all these small caps and everything, and you will have seen what's working. And like Keith always says, he starts to lose money right before he knows that the shift is coming. So if you come in at that point, or if you come in at the point where commodities have been like right now, if you've subscribed now on the back of this 18-month run in commodities, then you've come in just at the point where you're like firing off all these trades on commodities, just at the point where everyone else is trying to get out. It's like, well, it's been an 18-month run. So if you're a new subscriber now, although a lot of the commodities have fallen out of the products. If it was a couple of months ago, say.
But it was even end of November. Even in end of November, right? I mean, you were still. I mean, it was still kind of quad 2, and then being kind of like more of a quad 1-ish type situation, right? Where commodities are kind of third tier, but they weren't getting booted yet. Is my point. Right? In terms of, if you weren't pro.
So if you'd spent last year getting chopped up in stocks or whatever, and then you were like, oh, well, these guys are talking about commodities and commodities are doing great. And now all of a sudden if you've come in now, you've subbed a couple of months ago and you're like, well, everyone was telling me to buy commodities. And now
and then he shorted oil and covered it 3 days later. And then, it's ripped in our, it's so nuanced. It's that, it goes back to that, just a full cycle investing, like that is such a key component to the process, right? Because it allows you to sort of like trade a bit, right? And take advantage, you're selling at the top of the range, you're getting that mean reversion, and then you're buying more. So then but you still kind of got your, again, I don't really love to talk about cost basis, but just, you got that kind of like core cost basis of say 2-3%, whatever it might be. And then it allows you to basically trade that other kind of like, again, talk about, like, say it's a 6% position, gives you that 2 to 3% to play with as the markets move, and that's where you can really, as you said, kind of goose your returns.
And one thing I'll add to that is I kind of think you can really think of markets as that they're always doing one of 3 things, or some combination of these 3 things. They're either going up, they're going down, or they're going sideways. And if you're buying breakouts, you're only making money in one of those environments. When it turns around and starts going down, you're going to lose money. And if it's going sideways or consolidating, it's going to chop you up. The advantage of the risk range system is it allows you to make money in 2 of those 3 environments. Because if you're buying at the low end of the range and something is going to continue to mean revert, you can do well in something that's mean reverting. You can make money, and you're also going to make money if it starts to trend. You're going to lose money if it goes down. So you're, instead of only being able to make money in one of those 3 environments, which I have come to believe buying breakouts is only allowing you to make money in one of the 3 environments. Yeah. The risk range system is allowing you to make money in 2 out of the 3. So it's a much more advantageous way to play markets if you've got the right system to do it. And we could start to, if you want to get into like Bollinger Bands, and because I think that and bands and kind of all together is hugely important to how you approach markets in that way, and what rules you set for yourself.
Yeah, let's do it. Let's dive into it. Yeah, educate not only myself but many others on the bridge band process.
Yeah. So I want to caveat as I start to talk about this that for anyone's watching who is or isn't familiar with bridge bands, I'm sure everyone's familiar with Bollinger Bands. Neither are the risk ranges that Keith uses, right? There's a complex set of variables and decisions and inputs that are going into those ranges that none of us are privy to. All we can do is use the information that we're given in the risk ranges every day and decide how we want to use that. Because here's the challenge for us, right? We get a lot of great information from Hedgeye. You probably are only getting 20 to 50% of what you need to have a full process for yourself, right? All you can do is take the information you're getting and augment your own process. So that was the challenge that I had, was the risk ranges are great. You only get those in a select set of assets once a day. That's the system. So how do you apply the information that you're getting there to all the other markets intraday and beyond just the asset classes that you're getting them in? Well, there's a couple things that you can do. So what a lot of people do is they use Bollinger Bands, right? You can set Bollinger Bands to, call it 15 bars on a daily chart. That would be the equivalent of 3 weeks. Keith talks a lot about 3 weeks or less as somewhat the time series that he's using, although I do believe that his time series is variable. It's not a fixed amount of days, like as simple as that. But that's a starting point, right? And if you'll find, if you look at it the way that I've looked at it, and the testing that I've done, is sometimes in some assets, a 15-bar Bollinger Band is going to get you fairly close to his risk ranges. Here's the downside. That's going to fail right when you need it the most. And that's the downside of Bollinger Bands, is that they fail right when you need them to work the most. And the reason is that Bollinger Bands assume a Gaussian distribution of price. So without getting too technical in it, Keith talks a lot about Benoit Mandelbrot, his book, The Misbehavior of Markets. I think that's required reading for anyone that wants even a tacit understanding of the Hedgeye process and the way in which he's applying just principles of the universe to how he trades.
So true.
And so the downside of Bollinger Bands is that they're assuming a Gaussian distribution. What that means is, height of human beings is a Gaussian distribution where there's an average height and it follows a nice, normal, beautiful bell curve. You are probably never going to encounter someone who's 17 feet tall, and you're not going to encounter someone who's 1 foot tall. You're generally going to encounter people that are on this bell curve. And the flaw that people have made over, this is going back centuries, is they've applied that idea of Gaussian distribution to financial markets. And what Benoit Mandelbrot proved, I think beyond any shadow of a doubt in that book, was that is just not true. That these quote unquote black swan events or returns that are outsized, that are far on the tail ends of the distribution, occur far more frequently. So if what Bollinger Bands are, just as a quick primer, is all they are is you take a moving average, whatever you want the moving average look back to be, and you apply standard deviations to it. And typically you would apply 2. And if you're taking a moving average of something and you're applying 2 standard deviations, you are in effect saying that price distribution is going to be Gaussian. It's going to be a normal distribution on a bell curve. So if price moves up or down or goes here, it should, in quote, should fall within that bell curve, that normal distribution. Yeah. So if something goes outside of a Bollinger Band, you're betting on mean revert. You're buying it if it's below the Bollinger Band. You're saying, this is going to mean revert. I'm going to buy it here because it's going to go up, because that's what Gaussian distribution says it should do. Here's the problem with that. If you look at the beginning of the quad 4 COVID crash in the beginning of 2020, perfect example. If you look at a chart of the S&P 500, So I forget, where we were closing into February at that point, but the market started falling off a cliff, right? Like every day it was lower, 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 lower. Keith's risk ranges were tracking that very tightly. And that was exactly what you needed, because you needed short-term overbought signals to get out of your longs, like if you were leaning too long into the beginning of that, like I was, and to initiate shorts. Go back and look at a chart of Bollinger Bands. Pick whatever look back you want from that time frame. As price starts to go down, the top end of the range, so to speak, the top end of the Bollinger Band is up beyond the all-time high. Because
it's just getting wider and wider and wider.
Because what Bollinger Bands are telling you is, well, here's the mean. The mean was wherever the S&P was closing up until that point. Now it's getting pelted every day, lower and lower, way beyond what Gaussian distribution says it should do. So because that's happening, then it's equally likely that it could happen in the opposite direction, which is an absurd assumption, right? So that's where Bollinger Bands are actually going to become relatively useless. Is they're not going to give you the distribution that you need. So what I did with what I'm calling bridge bands is take a principle of call it fracticality that Mandelbrot talks about in his book. I believe it's chapter 9. It's the chapter about the Nile River and how high should you make a dam based on how high the waters have gotten over the last however many years. And he uses this way of determining the historical variability called the bridge range. So it's different from just looking at the average and averaging everything together and finding a standard deviation. And long story short, in summary, what he calls it is a symptom of scaling or fracticality. So it's a way to change the way that you're looking back at prices. There's a video I did on this where I go into a lot more detail, so I won't go into the detail here. But net, what the bridge bands are, they are not risk ranges. They are not meant to replace or even supplement risk ranges. What they are Bollinger Bands with a fractal overlay, meaning that as price starts to move in a direction where you see that persistence that Mandelbrot talks about in misbehavior of markets, where you're seeing trend persistence in a direction, the bridge bands will track that better than Bollinger Bands will. That doesn't mean that they're kind of a holy grail, or that they're going to even be close to the risk ranges at times. A lot of times they're not at all close to it. But if you've got nothing, this is better than nothing. And I do believe that it's better than Bollinger Bands. And some of the preliminary testing I've done has shown that it does give you at least a slight edge over Bollinger Bands. Doesn't mean it's necessarily universally profitable in all markets at all times, but it is going to give you, it's a better way to look at kind of a random chart if you've got nothing else than Bollinger Bands. So that's kind of a quick primer on how they work and why there's at least an advantage to them over something like Bollinger Bands that are assuming a normal distribution.
Love it. Yeah, and I just pulled it up, guys, just to have and for our kind of viewers. So this is sort of I put on the indicator here. Again, this is on TradingView for those who aren't familiar. You can find the bridge bands, JoeCat 808. This is one of my first introductions to Joe back when when I first started, really was, so in kind of, 2020, call it, I mentioned this the other day, so during kind of call it April, May-ish timeframe. And yeah, exactly that, Joe. I was trying to figure out, okay, for those, tickers or symbols that, we're talking about or we're investing in, it's an ETF Pro, we're not getting the risk ranges, how can you start to overlay some of that, for other entries, and also, key things like recognizing like lower highs and or higher lows, right, and stuff like that, right, from a trend, your momentum, et cetera, et cetera. This was an awesome. So again, thank you. And I think you mentioned the other day that you technically didn't publish this, so or you didn't create it, but whoever created it, big thanks on TradingView, and big thanks for making it absolutely public, because I think that's just a completely awesome thing to have out there for all of Hedgeye Nation. Yeah, and
I didn't code it in TradingView itself, but yeah, it's based on the same math, and I've gotten a lot of, thanks on this, private messages. Thank you for creating this. What I've never had anyone say is, thank you for creating this so I don't have to use the risk ranges anymore. I can unsubscribe from that. No one has ever said that, because that to me is suicide. I think, but here's what I'll also say, because I think this is important too. This is at most half the whole battle, right? And
Oh.
I think if you were to take the math, the real way that the risk ranges work away from Keith and give it to someone who didn't know what they were doing, me, say I had the magic keys and Keith had only Bollinger Bands, I still think Keith would outtrade me, because this is only going to define overbought and oversold to you. And there is so much more beyond just knowing where those levels are to actually trading profitably. That's where most of my time and energy and effort has been spent, certainly in recent times, is, okay, I've got a model that's, got some usefulness to it. And the way in which I use them is a little more complicated than it's quite a bit more complicated than what's on TradingView. Because I started seeing the advantage of variable look back. So varying the look back with volatility. And I think that's closer probably to what Keith is doing, because I think that's what's missing in kind of all indicators is, moving averages or Bollinger Bands or whatever. You're just setting the look back to some arbitrary time, even if it's 3 weeks, and you're saying that's always what matters. And Keith has given hints over the years that his look back is variable, and that I think is key. He's using instantaneous volatility. He's using the volatility of volatility as volatility is changing. The way in which he's using that information is changing as well. And I think that's so that I say all that to say that it's far more complicated than any of us even realize. But even if we had the keys to it, I don't think we'd know fully what to do with it, even if we had it. I think so much of this is trading experience, knowing how to use those overbought and oversold levels, and sizing. Sizing is absolutely critical. That is the third dimension. Everything that you see about price volume volatility, that's 2 dimensions. That's just looking at the market. Sizing is the depth of how you take that information and use it to create your position, where your cost basis is, where you're exiting, where you're entering. And that, Keith gives some hints on that of how he's doing that. He says 50 bips at a time, 25 bips at a time. He gives you kind of his max position sizes based on asset classes. But there's so much beyond that he's not giving, that is up to us to kind of figure out, right? So that's where I think a lot of my time has been spent, and where a lot of newer folks, where they're best served spending their time is developing their own sizing system, their own entry and exit system, and how they're using the risk ranges, rather than trying to figure out the risk ranges, thinking that that's going to be the secret edge. That it's not.
I think it's kind of how we closed the last video, which is I've lost track of how many times I've said it, that it's, and I've stolen it from Keith, but it's never one number, right?
Yes.
It's like I've already said it, to simplify it, to make it easy to be able to transmit, and to be able to try and teach people, and have it to be something that can be said every day, to try and hammer home these certain points, is by making it one number, you're naturally having to take the complexity out of it. But the reality is that it's so much more complex than can even possibly be shared every day. And I think you've kind of alluded, as volatility increases, the time frame has to shorten. So naturally, if you're not able to, be in front, to be in the chair for as long as anyone else, it's naturally, it's not a disadvantage. It's just, you have to understand the game that you can play. It's that you, not the keys to the castle, but there's so many things that Keith is sharing. It doesn't necessarily mean if you're not in front of the computer all the time and be able to, to be able to make these decisions, sometimes it's even a better decision to take a step back and say, right, my game is being played, where I sit down and do my notebook review on a Sunday night, and I kind of make my decisions that I then input on Monday, and then I don't touch anything.
Which is exactly how I do it. And that's counter to, Keith has said a lot, like, you got to be bolted to the chair. And we know Gavin's in the seat. Gavin has a process and a system where he operates in that way of doing it. I work a lot of us work full time, right? But there's the nature of my job is it's hard for me to look at the market intraday.
Yeah.
So I operate that the way you were just describing, where I've got, I kind of at night, I set my aftermarket limit orders based on the ranges that I have. This is where, and the whole trick is those ranges are the easy part. The hard part is the sizing. Okay, based on the action of price volume volatility in this asset and my cost basis and how big I am in it right now, yeah, I can buy more here, but should I buy more? How much more? And that's the whole game. And then a lot of times that ends up being a great way to do it, because I'll look at the market after hours. I'm like, oh, I caught the bottom without even realizing it. And that's helped me, because I've looked at it and I've gone, if I was looking at that intraday, I would have sold that.
I would have sold it, and you would have, yeah. It's
or might not have stepped in or moved that limit order down further or something something of that nature, right? Where you're like, oh yeah, no, 100%. And yeah, I'm a big believer in this, and then Gavin mentioned this on Saturday in his video that he made. Isaac kind of asked about process oriented video. It's so personal, and I mentioned this. I think it's so personal. Everybody handles it slightly differently. You get all this amazing, and you've touched on this already, Joe. You get all this content and research, but it's how you kind of like basically mold that clay into what makes sense for you, for your investing style, for your time. I'm similar to you, Joe, that I've got a full-time job myself. I luckily, do have time to kind of like keep an eye on the market throughout the day. But there's some days that, I have zero. I mean, I've got, three demos or 3 conference calls and, 3-4 conference calls. And it's just all of a sudden, the market hours go in a flash. And, if it wasn't for that work, at nighttime or first thing in the morning, setting those limit orders, that kind of stuff, you wouldn't be, I wouldn't be selling it, at the top end of the ranges, and I wouldn't be buying at the lower end of the ranges.
Right. And you're making those decisions beforehand, and you're choosing to commit by doing that. And you're saying, this is where I'm going to make that decision, and I'm not going to change my mind about it. And there's a balance there, because you got to commit, but then you also got to think like a Bayesian, and as new information comes in, you're changing your mind. And I think one of the great things about Keith, but there's a downside to every way that you trade markets, is he has a very high threshold for signal versus noise, meaning he will consider most things to be noise. That's why he's always talking about episodic and non-trending with volatility. And that's been hugely advantageous for the last year, because we've had all these viable dips with volatility spikes. And so that's the challenge, is you can think about signal versus noise in that way, where you have a high threshold. The advantage of that is you're going to stay with trends longer. The disadvantage of that is there's a big give back between the last time that you choose to buy a dip or whatever, and then when you stop yourself out and say that you're wrong. But then there's also disadvantages to doing the other way, where you have a low threshold for signal and you're trying to nail every move up and down, day to day, week to week. That can chop you up. So you got to kind of figure out, I think you said it perfectly. It is very personal. I think my advice to newer folks who are joining Hedgeye is, don't try to be Keith. That's not what he's there for. And I think I see that in the queue, in the macro show every morning. I was that way, is you understand this guy has a lot of knowledge and experience. So you just want to trade like him. Just figure out what he's doing, get his keys, make a risk range, do everything the way that he's doing it, copy him, and just copy all his moves. And he jokes about that, right? Like, what everyone wants is like a window into his PA, and you just copy every single trade that he made. That's not how this works. Like, you have to take the coaching of what he's giving you and apply it to your own process. And you look at sports teams. If you look at, you think all the athletes on any team are trying to play the way the coach plays. They're taking the advice from the coach and applying it to the way that they play. And I think what's great about, like, these Twitter space calls that we have, the calls in the Facebook group every week, like, you're seeing that there's a way to take this information that's being given. And it's actually a good thing that you're not getting a 110% complete process of, like, this is exactly the portfolio you should have, and these are the moves you should make. Is you're getting a primer and some coaching and some data. And now it's, okay, go off and make it your own. And that's I think where newer folks are going to struggle, because you feel like you're getting an incomplete set of information. You are, but that's intentional. That's by design. And you have to take that incomplete set of information and make it your own and apply it to the way in which you see markets and you trade and you do things.
I think that's a big thing for me, because although I share all these charts and stuff on ETFs, but I don't trade any US. So a big part for me, like, I use like this much of the risk ranges, because I just use like all the FX,
the FX ones,
right? So when everyone's like, oh, I want ARK in there, I'm like, I don't want ARK. Give me the US dollar ruble or whatever. I don't want ARK in there. It's like, so I suppose I'm going to be different to a lot of people, that I've had to make it my own, because so much of what I trade isn't included in the Hedgeye process. So I really have to listen to the macro show. I really have to listen to all these things to pull out the stuff that he's, that's not on the daily products, that's not on the weekly products. And like you said, using all these calls you can see how diverse, considering we're all coming at it from a different angle, but just what people have learned from Keith, you can see how diverse it is and how different everyone's had to interpret
and you said it perfectly a few minutes ago, and you said it's never just one thing. There's so much to glean from the process and what he's teaching. Like for me, I mean, there's a dozen things. There's 4 big things for me, right, that I've learned from Keith. Number 1 is a quad model, just the concept that the market only cares about growth and inflation, in part because the market only cares about the Fed, and the Fed only cares about growth and inflation. Like that kind of put everything into a framework for me. So that was the number 1 thing that he taught me. Number 2 is that the secret to life, the universe, and everything is the rate of change. We all think in rate of change and don't even realize that we're doing that. When you're in an airplane and it starts going down, you're freaking out because the altitude is changing, not because you're still in the sky. You're not like, well, I'm still in the sky, so I'm fine. We all think in rate of change. That it's not about good and bad, it's about things getting better and things getting worse. So that's number 2. Number 3 is price volume volatility. Those are the basic components of the market. They're the atoms, so to speak, that comprise asset markets. Like, I was already heading down that road before I found Hedgeye, and he really affirmed to me that I was on the right track by just trying to break it down into that simplicity and not worrying about derivative things like indicators and chart patterns and technical analysis. That's overcomplicating it when you really just need to be focusing on the base components. And the 4th thing that I think it's so specific, but it's the way in which I built the beginnings of the bridge bands, and it is the advice I would give to anyone who, you don't want to go and create your own model, but you want to do some of this on your own and really take what Keith is saying and apply it to everything intraday where you don't need to lean on him, is the importance that the primary drivers of asset markets, i.e. the machine that Keith always talks about, are 3-month and 1-month price momentum, specifically 1-month price momentum. I think that was eye-opening for me to hear that from him. He talks about that all the time. And the more I tested, the more whether it was manual back testing, paper trading, actual trading, everything that I was looking at, when I started looking at it through that lens, it started to make sense to me that the machine chases changes in 3 and 1-month price momentum. And if you're in something and it's bullish trend and 1-month price momentum, and I always get questions like, how do you calculate momentum? Do it the most monkey way you can do it.
Yes.
So 1-month chart, is it higher or lower than it was a month ago? That's momentum. And we sometimes make it too complicated, right? Because even though he laughs at moving average based systems and indicators, a lot of Wall Street is based on this oversimplification, this false, a flawed way of doing it. So if you understand that that's the way that those machines are operating,
built.
You can play against that. That becomes your backboard. So and that's why he makes his immediate term trade range 3 weeks or less, because he's trying to front run that. He's trying to get ahead of where he sees the machines are gonna chase something up or down, either sell out of something, or 1-month price momentum has changed to the upside, get in it and chase it up. And I think if you just if you don't have a model and you just have a Thinkorswim or TradingView, whatever you're using, set your windows to 1 month and 3 months and just watch it day to day, all these things, write down where it is. And as things start to change and 1 month breaks and 3 month breaks, you will see over time that more often than not, prices start to trend in that direction once that aspect has changed. So that was the kind of the way I started, was just basing my system on 1 month and 3 month price momentum. And Keith's is far more complicated than that. But that is a solid baseline and place to start. And that's a place that anyone can start without a fancy model or knowing how to code or anything. You can just have your chart set this way and learn a lot by just paying attention day to day.
Yeah, I mean, Joe. So go ahead, Chris.
No, I was just going to say, I think the fact as well that if instead of getting all these ideas, not to downplay Real Vision, but whatever, you get all this. You get all this news and data and everything. You're like, oh, this coal ETF or this blah blah blah, this whatever stock. When you're looking, whether it's the US ETFs, if you're looking at the same 50 things over and over and over, and you have these, these simple points to look at of momentum, whatever it is, instead of being like over here, then over here, then over here, when you're looking at 50 things, you spot that these things tend to, oh, it's happening again. Oh, it's happening
Focusing
again.
your attention. Exactly.
So that's why the big thing for the quads for me is, if I kind of came in from a trend following perspective coming into Hedgeye, and it's like, okay, but now I can take, instead of looking at 500 things, I'm still looking at them, but the quads allow me to have, yeah, okay, you can look at your 500, but these 25 or 30 are more likely to have a higher probability to have a good outcome. So you're still looking at everything, but concentrate on these ones just a little bit more.
Exactly. And where the signal and the quad are agreeing for certain assets. Right? So you're seeing that in some rate sensitive stuff, like utilities are holding up well, REITs, housing. That's where you want to focus your attention. Healthcare doesn't look as good. Healthcare should be doing well if it's quad four, but it's not really doing that well right now. Okay, so just don't focus on that. I think the mistake you see a lot of folks make is they look at the quad map. Oh, these are the things that I should be long. And then they're asked, like, they're mad. And they're like, how come these things aren't working? Well, because they're not working. It's not, it's just a roadmap. It's not this is exactly how you should construct your portfolio, and don't ask any questions.
I think as well, if especially now, because everything's kind of in a bit of indecision, is, let's say the top, whatever quad it is, let's say the top 3 of the 4 of the sector ETFs that are longs in this quad. 1, 2, and 3 will be doing well, let's say, but the other one, people will pile into that one because it's the only one that's down.
Yeah. And that's what you just said is key, because that's where I think, if you oversimplify and say, oh, just buy at the low end of the range, you can really get upside down doing that. And that's what happened to me in the beginning. So I sympathize with a lot of newer users who are encountering that issue, because you have to, and that's where 1 month and 3 month price momentum was key for me, right? Because something's at the low end of the range, but 1 month just broke and 3 month is about to break. Well, then maybe that's not as good of a thing to get into as something that's in the middle of the range, but has retained 1 month and 3 month price momentum. So that's where the game gets more complicated.
So spot on. And again, I'm sharing my screen just to show folks, because I mentioned Koifin on the notebook review last Wednesday. But again, this is just something that they have built in, these market dashboards. It's free. I have the column set up. Again, this is so rudimentary and basic, but it's a great way of just quickly toggling in to looking at, okay, what's got 1 month price momentum? And to your point, I mean, XLU just barely broke, right? So it's like, it has been strong, right? It's 6.5% over the last 3 months. So it's got that trend, but the trade it's teetering on it. So it's going to be really important to see what happens. I'm going to wait for kind of make a decision here this week, or at least next couple of days, to figure out, right, like where is it going to be on the risk range or what have you? And, am I going to be, adding, basically sizing that up aggressively because it is at the bottom end of that, basically that trade, right? If it doesn't break, then we're likely off to the races, and I want to be bigger in that. But you mentioned, Joe, earlier about kind of like the sizing, and I think this is exactly right? Like XLU right now is, for me, is about 250 basis points of capital exposure. And, I historically or in past would have basically this past week been taking that to almost 6%, but, but I, to like a max position, but I noticed that it was kind of losing a bit of that trade, or it was at least flirting with the trade. Again, I don't have the trade line, but just call the 1 month as trade line, right? For simplicity. And I could tell it was like flirting with it. And that's a big no-no, right? In terms of, that's how you can, as you said, get really upside down. And just to finish my thought here on Koifin, and then I'll go back to us. But I mean, this is awesome in terms of, it's got the country ETFs. It's even got, fixed income factors exposure as well, right? So you can kind of review it, group it by 1 month price momentum, that kind of thing. So for those that aren't using Koifin and you're looking for something very kind of, it's not even basic, it's just very simple, because it's literally here for you. You just have to set up the columns. So I'll just kind of pass it back to you, Joe. But
no, and that's great to show, because that's a way for, because I get asked this too. I got like people, they don't know how to code. They don't, and I don't think that you need to know that. You don't need to understand the full intricacies of a fractal model or fractal math or to know how to code to be successful in markets. I think having a fundamental understanding of that gives you an edge. And I think that's, everyone should read The Misbehavior of Markets, because it's really not a mathematical book. It's a book where he kind of explains his findings and how he was able to prove that conventional wisdom in finance is wrong. And I think it's a phenomenal read for anyone, even if your intent is not to ultimately build your own model. And I don't think you need to have a model in order to be successful. I think Keith gives a lot of his system to allow people to have that baseline. And what you can do is take that and make it your own, and just find these other nuggets like what you were just showing. What is the return over the last month and over the last 3 months? And what you just said was spot on, because you're seeing that something is changing in XLU that, you know, hasn't been there before. So maybe that for you, that doesn't mean sell it. It just means maybe don't take it up to a full size right now. Maybe wait, maybe be a little more patient. Maybe look at where the, you know, the trend line is, or however you're defining trend, if it's, you know, the 3 month momentum, and wait and see there. Because what you'll also see happen a lot are these head fakes. And that's Keith, I think his whole idea of neutral trend and the way he talks about trend is he gives things a few days before he says that, before he's out, or before he, because and I've seen that too. The things that break trend, I saw that, you know, I got chopped up in oil long earlier or last year because I like got out as soon as it broke trend, and it was like a clear head fake, and just boom, and right back up. And that was trend on my system. I think it was bullish on his the whole time. So again, where there's a difference, lean on the way the signals that Hedgeye are giving you, because that's what he's trying to do, is have that high threshold for signal versus noise to keep you with the trend. And that was the, you know, if you were really approaching the information you were getting from Hedgeye last year with that mindset, I'm sure you did very well, because it paid to stay with that commodity trade for the entirety of 2021 and a lot of 2020, if you didn't allow yourself to get shaken up by those episodic and non-trending breakouts and volatility. And that's where the way in which you use 1 month and 3 month momentum, and the way you define your sizing in different moments is key. And that, again, like you guys said, it's very personal. I can't give advice on like, this is how you should do it. This is just how I do it. And it's taking everything Keith does, augmenting the way that I do it. And I think there's a lot of different ways to take what Keith is giving and augment your own individual process successfully.
Yeah, that's fantastic. I think, should we kind of wrap up, finish up with maybe your current outlook and sort of how you're positioning yourself today? And I know you'd mentioned to Chris and I on chat about, you know, how you really think Hedgeye in particular in your time has like nailed a couple different moments in the course of market history, call it, right? So I'll let you kind of expand on that.
Yeah. So and I've been a subscriber since, you know, beginning of 2019 and end of 2018, around there. I think there's been 4 calls or 4 times just in that time that I've used them where they've nailed it. One was that call, the Q4 in 2018 slowdown. That was the first one. The second one was the quad 4 call at the beginning of the COVID quarantine. Like that was the best. That was the best call I've seen anyone ever make, let alone the best call that Hedgeye's made. The third was,
out of curiosity, did you? I came in kind of right after that. Did you pretty much pull off? Like, I mean, was your drawdown very nominal or minimal?
I completely screwed it up.
Okay.
It's not Hedgeye's fault. I thought I was smart and thought I would get long defensive things, and I was way too long going and not short enough, because I had been burned shorting so much. And Keith, I did exactly what Keith says not to. Like he coaches a certain way, and I was ignoring it. Like, you have to understand how to short. You have to have a short book. Long's bigger than you short. All the things that he says about shorting, I had just been burned in 2019 trying to short so much that I just like didn't want to do it. I was like, oh, it's quad 4. I'll just buy utilities and housing and REITs and I'll be fine. And I was not fine. So I'm separating my own performance in that from the call itself, because the call was phenomenal. And I wish I leaned fully into it instead of trying to get clever and do it my way. I hope that answers that. So that was the second. The third phenomenal call that I've seen was the multi-quarter quad 2 acceleration that they called at the end of 2020. So a little over a year ago that we had from Q4 2020 into first quarter 2021. That was, they crushed it.
October,
The fourth is right now. And I can say that I was proven right on the other 3 because they're in the past. This one, it's going to take a while. It's going to take about 6 months to see that. I've never had more confidence in the call that they're making. the challenge is being able to make money. And you know, Mike Taylor always talks about this, right? Like, don't be right, make money. It's easy to be right and still not make money. Just because you're right doesn't mean you're going to make money. So that's the challenge here, because if you look at certainly the price action, the feelings, the way it looks right now, it certainly feels like the reflation trade is still here. Reflation is here, reflation is on. And I think the consensus of the market is that inflation is going to continue to rise, and Hedgeye's taking the other side of that. And even though I wasn't a subscriber, Chris, you may be able to speak to this, in 2018, in looking at, I think someone shared a great video on Twitter of Keith in 2018, like at a moment similar to now, where he was probably getting a lot of flack for being long bonds and they weren't working. And it was right at the moment where everything, so he was wrong for a couple of weeks. And
I love that clip. I love that clip. Bring it, bring it, bring it. You know, it's just like, yes, yes, coach.
This was, I guess it was the time where like the Bond King was on Bloomberg and everything, and talking about 4 or 5% rates.
Yep.
And I also post some stuff on the exchange on Real Vision. It's really funny that through 2021, I was posting some stuff about yield curves and stuff like that, and just really simple, like 2s and 10s. And I'd make a post because Raul always says, "Oh, the bond market knows best."
Yeah.
But when the bond market was going up, he doesn't know. He never talks about that, right? So when interest rates are going up, he never talks about that part. So I just make a post every now and again, sort of like saying, "Oh, this is this is the US yield curve steepening. This is the German yield curve steepening, Italy," and I'd be going through it, and I'd get no replies. Nobody'd answer. There'd be nothing. No conversation. There'd be one guy who would answer, but it was someone who I'd talked to a lot, and he was really interested in the interest rate market. But it was really funny coming into now. All of a sudden, it's questions are coming up of, "Oh, how can I short the bond market?" And there's like 50 replies of like, "Oh yeah, we've got all these inverse ETFs and we've got blah blah blah." And I'm like, "What?" I was like, I made, because I'd joke, I'd call it the same title, like, "Are we talking about bonds anymore?" So I had 1.0, and then I had 2.0, and I think I got up to 9. I think the last one was 9.1, because I was like, right, I'm getting bored of this now. And there was nothing, like one reply. And then all of a sudden, as we've come in like last week, "How can I short the bond market?" And there's like all these people that's like, "Yeah, we can do this, we can do that, and we can do all this sorts of stuff." And it's like, no.
And what does that tell you? And so I was kind of thinking of this, I think, last night. Like I really don't like the aphorism in markets that the market is always right. I think that's lazy, and that's an incomplete way to look at it. That's like saying gold is an inflation hedge. It's not that the market is always right. It's that consensus is always mostly right most of the time until they're critically wrong, and then they get everybody killed. And I think that's where we are. And that's what Hedgeye is calling for, is that consensus has been right. They finally caught up to inflation and the inflation narrative. And consensus is that inflation is going to continue. Bonds are going to continue to go down. Reflation assets, oil, everything, commodities, all going to continue to go up. And they're calling for the turn. And I think Hedgeye, Keith, he's trying to get everything right in the stack, from day trading, minute to minute, in real-time alerts, all the way up to the full cycle. And
yeah,
I don't care whether he gets the day trades right, minute to minute. That's not why I pay him. And I think that shouldn't be why a lot of folks pay him. And he was saying this on a recent call, that like the big institutions that pay him, they don't pay him for that. They pay him to get the cycle right. And that's what he's calling for now. And he's been wrong for a couple of weeks. And I am trying to trade my portfolio, to manage my portfolio, positioning for that deflationary turn. And I think there's 2 different ways you can do it. There's that way. I wouldn't really advise doing it my way, because I'm short oil. It's been tough trying to trade around something that I shouldn't be in.
Welcome to the club. I'm giving you an air hug here. Welcome to giving you an air hug.
So contrast that with someone like Gavin. And Gavin's playing it his own way, and probably the better way, and the way that a lot of people should play it. Is Gavin and you and I, all of us, probably have the same view. Gavin probably would agree with everything that we're saying, but he's not playing it that way. He's playing it where he's waiting until the signals are going to tell him that he's got the all clear, and then he's going to manage it actively. So he's choosing to be passive now, in cash, whatever that is, and manage the position actively when there's more certainty. Whereas what I'm doing is trying to manage it actively now, and set my portfolio up for the longer term, and then hopefully have a little bit more of a passive tilt to it, where I'm already positioned the right way, into that turn. And that's just two different ways of doing it. So you got to decide, do you want to do the work now and position you the way that I think Keith is starting to, or do you want to wait and watch till the signals are confirming, like till you see the whites of the eyes of the market, confirming that the turn is here, and then go for the kill, which is probably the way Gavin's going to play it, and the way a lot of folks should play it, because it's the less stressful way than being short something that's bullish trade and trend and hitting $83, $84.
I think on that it's I suppose obviously I'm looking at it from an international point of view. So if you look at quad 2 and you look at quad 4, so they're obviously opposites. In quad 2, you can buy almost anything.
Yeah.
In quad 4, there's only a few things. There's only a small pocket that you can buy. That's so your investable assets are much smaller, meaning there's fewer of them. Not that they are smaller, but to that as well. So for me, quad 4 is really important because there's the FX part of it, as in when there's a quad 4, the dollar is going up. So not only if I'm long TLT, for instance, not only am I getting price appreciation from the ETF going up, but the dollar is also going up against the pound, meaning if TLT goes up 10% and the US dollar goes up 5% against the pound, that's a completely different trade for me than if we're in other quads where the pound in general is kind of going up against the dollar. So it's kind of a double whammy. It's like quad 4 is really important for me because of the FX part of it, of being in the dollar.
You're just sitting there, you're just waiting for those moments, Chris? You're
It makes a massive difference.
Huge difference.
Because you have that double whammy. You have the FX part of it, especially if you're outside of the US. People don't tend to think about that part of it.
We Yankees don't think about that, but you're right. It's doubly important for you to get that right, and for Hedgeye's call to impact the way in which you're trading is doubly important. So,
and I have to take the part in where obviously we had China weakening throughout 2021. Whereas the US is going gangbusters and Europe was following, and if not leading it. It's how much more important is a quad 4 in the US globally than the negative impact of a quad 3 or a quad 4 in China. And it's like, at what point do the cascades that happen in the US feed into everything else?
And I know we're about to wrap up, but that was, Chris, I mean, is basically what I was looking at over the weekend, right? I mean, I'm looking at the quad maps in terms of like the global ones, and there's a lot of ones and ones and twos, especially in Asia, like emerging markets right now, even in Europe, right? I mean, obviously, certainly Q1 has been, they've been leading, but there's certain Europe. If you're catching it now, you're kind of late, right? I mean, you could get chopped up real quickly. And so I think it's going to be, Chris, it's certainly something that was sort of popped off the page to me. I think we're still got some time for it to kind of flow through or sort of figure out what that means longer term. But yes, it's very, very interesting. And I suspect you're going to see those quad numbers shift as we get closer to Q2, for a lot of those other, markets. But then, to your dollar point though, EM though can benefit from, EM gets hurt, get hurt more from a stronger dollar. Then you've got China doing its thing. They just did, the interest rate cut last night. They've got the Olympics coming, whatever, there's the narrative around it that they're going to do anything they can to get, basically look good, at least for the next quarter, call it. But it'll be, I think we're in for quite an interesting next couple of months across the board, which is even more reason why, having conversations around the process and how folks apply the data they get is even more valuable right now in this moment in time.
I think it's especially if people subscribed in like the last, I would say 3 to 6 months, because if you've been subscribed for longer, you've had the benefit of that 18-month run, right? So you've bought yourself the ability to take some time to figure it out. Whereas if you've just, if you've just put your money on the table for a subscription, you kind of want it to work straight away, like with anything, right? You're like, well, I'm paying for this now. And I think what we've kind of said from here is that actually you need to be giving it time rather than hitting the pedal on anything. It's that space and time part. This is the part, right? Okay, we need to just take a step back, have a look. If you are trading, it needs to be tactical. And then, but those tactical trades, you may start to notice that they start feeding in and become the long-term trends.
Yeah. Awesome. Well, Joe, this has been amazing. I mean, episode 2, I think everyone's going to be really, really impressed, not only by this conversation and your process and how you've developed it over the last 3 years, call it, but Chris and I cannot thank you enough for joining us. We're so grateful, and really looking forward to doing more of these. Hopefully having you back on and at another time. And yeah, because we could, if anybody could tell, I think we could chat about this for many more hours. So appreciate it very much, and thank you again for again, this is a Monday morning on a holiday weekend here in the U.S. So for you to take the time to sit down with us, we really do appreciate it.
Awesome. Well, thank you both. It was a lot of fun. Hope to do it again.
Thanks, man. Cheers, Joe.